Hey traders, welcome to Charts and Coffee. Hope everyone's having a good Tuesday morning. We've got jobs data every single day for the remainder of the week. We've got JOLTS data coming out today at 10 a.m. We've got ADP data tomorrow at 8:15 a.m. Thursday, our regular initial claims. And then on Friday, we've got non-farm payroll. And this is really important, gang, because while typically if we take a look at the rate of change of macroeconomic data, it's really about inflation, right? But a lot of times it's easy to forget that the jobs, the employment picture is part of the dual mandate that this Federal Reserve does have. And that's that, therefore, an assignment they've given themselves, which is to say, let's hit our inflation target, but let's not kill the jobs picture at the same time. So we get to grade Powell this week. And if that data suggests, now actually, I take this back. I was going to say if the data suggests the jobs picture is healthy, we've seen in the past where quote unquote good data is reacted to bearishly in the indices and even the treasuries and the euro. And why is that? Because for the most part, in an environment where the Federal Reserve is hiking, when there's data to suggest the economy is okay, they can persist on their path. But what about now? Now we're in a strange limbo. We are not going to see any more hikes based on where inflation is, unless there's some shocking PCE number that absolutely short circuits the Federal Reserve's inflation models. And that's pretty unlikely. Although, hey, anything can happen. But for the most part, let's work with with what we've got, data that we can work with right now. And that suggests the Federal Reserve could cut in 2024 as soon as the March meeting. And it is fully discounted that there will be at least 1/4 point cut by the May meeting. And so that means that unless something upends that, we are going to see accommodative monetary policy from a dovish Federal Reserve. And that's really it. There's your macro in a nutshell. And then the jobs picture, this is where the interesting part of it is. When are we going to start to see that positive data is reacted to bullishly? And that could be this week, right? That could start to be this week because we just have so much jobs data. We got the PCE last week. We heard from Powell last week. So just the juxtaposition of this data just set up where we could start asking ourselves, is it time to get optimistic when we've got rate cuts coming and the jobs picture remains at least even keel, if not maybe healthy? We'll see what happens. But the question then would be, what if it's a miss? That's going to be bullish, gang. That's going to be the bell that Powell hears going, oh my gosh, too high for too long, breaking the jobs picture. So bearish is still bullish. What we don't know, I should say, a miss and data is still bullish. But if it's a beat, could that be bullish too? I know. It's kind of like telling somebody how to tie a shoe. It's just easier to show them. But that's what we're going to be preparing for this week. So as always, gang, thank you for being here for Charts and Coffee. If you have any questions, type them on in. Phone lines are open for your requests. And yesterday was, I got to tell you, and I love that the traders in my mastery get that everything isn't about A, win rate, and B, just winning. Trading can be hard. And the last 2 months have been challenging. And the last 2 months remind us, and I've gotten a few emails from members saying, Rag, I am so glad that I understand the concept of position sizing. I'm so glad that I understand the concept of how much risk I'm going to have in my account before I take the trade. That's really the calibration we all need. And I'll tell you, October, November reminded us that position sizing is the holy grail. But I've been optimistic about December. I've been talking about that all through November. And it was really generous yesterday of the S&P. And I chose not to take an aggressive trade on the NASDAQ. Otherwise, I could have been talking about two very nice moves to the downside. It was very generous of the S&P to give us a nice SPY put that went ahead and went 2.5 times what we paid for it. And that's the kind of trade that I love having before 11 a.m. I love getting that set up in the morning. And then whatever happens the rest of the day, let it. I like having that very truncated, maybe 60 to 90 minutes of a day trading window and then move on to swing. Now, the swing trading window uh, really is going to start to open up with jolts. Yesterday, there were a number of swings that had good technicals, maybe even good volatility pullbacks, but poor timing. So let me show you what I mean. This is an example. ES, by the way, gang, would map to. I didn't turn any lights on. I mean, I don't know that it matters. My hair and makeup team wasn't here today. There we go. There's some light. I look like a villain from a Batman movie with no lighting. All right, here we go. So yesterday we had price sink into the daily price movement range. So some folks might say, yeah, Rog, what gives? Why would we not buy that? Because remember, gang, it's really the culmination of four factors. Always, the more of these factors we can put into play, the better off we are. So first of all, moving down to the daily price movement range, gray zone, support. The 200 propulsion, those white dots, support. Staying above that's kind of a big deal. But why not buy that? And look what's happened, by the way, in the time since. The reason is there's still another big piece of data. So if we can get factor number one, price, we're all operating with price. Factor number two, either price-based volume or volatility, whichever one you want to put in second place, the other one goes in third. So price-based volume, volatility zones. The fourth factor, the one that a lot of traders get stung by the most, I did too once upon a time, is time. What's on the calendar? How can we use different catalysts, different events? And again, we've got 4 of them this week, the remainder of the week. And every one of them are going to be important jobs numbers. So every one of those opportunities is going to be a chance for us to take advantage of, especially on the S&P and the NASDAQ, especially in tech, communications, and financials. It's going to be an opportunity for us to get in a long swing position, which I'm really looking forward to be able to do, because what that's going to allow us then to take advantage of is the nature of December, which is strength gets stronger. By the way, yes, weakness can get weaker. Tax loss harvesting, tax loss selling, that weakness gets weaker if a stock is negative on the year. That's actually kind of difficult to trade. It's a whole lot easier to trade window dressing and then the last week of the year, the Santa rally. All right, so that's where we sit this week. Super, super excited about what's to come. Gang, if the markets are open, we have a chance to manage risk and find opportunity. And, you know, that's what I love about this game. I mean, what's a trader's best friend? Tomorrow, right? We get to do it all over again tomorrow. All right, how do I feel about the XLF? Eddie, I hope I don't feel anything, but what do I think about it? What do I see? More importantly, I see bullishness. I see strength in things like JP Morgan. I see strength in high concentration weighted stocks within this financial sector. It's a big reason why the S&P is keeping up with the NAS, and I want to buy the dip here. What is buy the dip, gang? We hear this, you know, a lot of folks will sort of mock buy the dip. By the way, that's my entire career, buy the dip. They'll mock it. Why? Because buy the dip has a prerequisite. And the thing that must come first is the environment high probability for dip buying? What's a dip? It's a retracement. It's a reversion. It's a pullback. Call it whatever you want. If the market, whatever symbol you're looking at, is not already in an uptrend, then the dip is not really something that would be high probability. Now, that's not to say in CHOP we can't look at overbought and oversold, but for me, a dip is very much a trend correction or trend retracement or whatever the word is you want to use, that suggests that rather than buying at higher highs, we wait for a little bit of a pullback and then we engage. All right, could I please review how I use Darvas levels? I mean, they're really simple. Darvas 2.0, which is a modernized version of the Nicholas Darvas box, is automated support and resistance. There is a candle count and a pattern that occurs consistently that allows us to put these lines automatically on a chart. So I'm not drawing anything. There's no settings, nothing, right? It's just automatically identifying a version of a pattern that's been discussed and used and relevant since the mid-50s. Talk about time tested. And then how do I use it? My friend, it's support and resistance, just like just about everything else in the market. The context of support and resistance is the difference from trader to trader. right? One trader looks at resistance and says, I think it's going to break out. Another trader looks at resistance and says, I think it's going to be stuck there. There's your difference of opinion. So support and resistance, finding it is only step one. I like to automate it, increase speed, it increases accuracy. And number two is, how do I use support and resistance? And that's got to be within the context of the trend of the market structure. All right, next question is, how do we address the question about rate cut theory that was nearly identical last November? Rate cut theory that was nearly identical. Last year, we were also seeing rate cuts coming in March 23 or May 23 on the Fed fund futures. I can't say for certain. That's a year ago, but no, I don't believe Fed fund futures were showing rate cuts for that time of year. No, my friend. I can't say yes or no. I'd have to go back. No, my friend. If you look at Fed fund futures, I'm rather certain. I'd have to go back and look at my notes. But no, there were no rate cuts priced in for those months. Now, maybe going forward, there were some. But no, that was a hawkish Federal Reserve. Bond yields were heading higher. Fed fund futures were indicating rate hikes. And no, there was no rate cut. So I'm not sure, my friend, what that data is. But I don't recall that. I'm going to at least leave open that maybe they had some adjustments and some swings. But no, I don't remember it. No, I cannot recall there being Fed fund futures data-based expectations for rate cuts. All right, next up, a dip. All right, so here's yet another definition for a dip: a thick sauce in which pieces of food are dunked before eating. You know, rainy days, I love dips in the market, but I will tell you, I don't like dips because I'll tell you, maybe I'm weird. The double dipping rule is one that is still not adhered to, as it should be. So I am suspect of dips. Yeah, I'm very suspect of dips, but not in the price chart. All right. Next up is let's see. Questions. Sergio asks, are the grab candles the same as 10x bars? No, not even close. They're very different things. Now, the one thing they have in common is it's cool to color code candles. There's a lot you can tell just from a way to color code candles. Now, I can only speak on behalf of the grab candles. 10x candles are something that John uses, which are really cool. He's been using them since, it's really funny. The reason I remember this is I had my class around grab candles and the wave just after John had his class on 10x. So that was back in 2017. And when I look at color-coded candles, again, speaking only on the grab, what these are predicated on are moving averages. There are actually 6 colors. There's 2 shades of each. There's a green, there's a red, there's a blue. By the way, that's where grab comes from: green, red, and blue. Just an acronym. And I'm terrible at naming my indicators. Green simply means bullish, and it's above the 34 EMA on the high. Red is bearish, and it's below the 34 EMA on the low. And if it closes in between there, it's blue, it's neutral. The lighter shade is an up candle. The darker shade is a down candle. And so that's the way the grab candles look at price action. And ultimately, for me, and I've been using these for, sometimes it's hard to remember, 22, 23, 25 years. I've been using them for a lot of years. And it's really just a candle that's using moving averages to determine whether or not I have a higher expectation being bullish than bearish. But it's not a standalone tool, right? I don't think, when you look at grab candles or 10x for that matter, it's what does that indicator tell me? And then what's another layer? And that kind of goes back to how many whys do we have? Kind of channeling my inner Simon Sinek. Know your why, right? Start with why. How many whys does a trade have? And again, I'll go back to those 4 factors: price, volume, volatility, time. So that's just one piece of it. All right. All right. Next up is once the Fed cuts rates, do I think energy will be bullish? 2 things, Jay. Two things. One, the marketplace, treasuries, currencies, indices are going to price in what they're going to do before they do it. That is, buy the rumor, sell the news, same idea, right? So they're going to act in expectation of this thing happening. So that's number one. So if rate cuts are to be bullish, well, they would start to kick in now, wouldn't they? And they're not. And that's because the central bank of crude, you might say, whoa, there's a central bank of crude? Yes, it's called OPEC. The US central bank controls monetary policy and money output, right? In a way, printing. Well, OPEC is kind of the same thing, only their currency is crude. And I'm going to pay attention to the central bank, OPEC, of crude for that signal. I can't imagine OPEC is pleased about crude closer to 70 than it was 80. But they haven't done a lot of saber rattling. There has not been a lot by way of adjustments to the production cuts. I'm not sure because I haven't done a lot of research the last, I'd say 3 weeks on how well those production cuts are being adhered to. It's one thing for OPEC to say, hey, OPEC producing oil countries, we're producing X, and this is the limit. This is the cap on your output. They don't always listen. It's a very strong suggestion. There's no penalty necessarily for not adhering to it. So we'll have to take a look. But for now, here's what I do know. What I don't know in terms of the data and the discussion and the narrative, I do know in the end result, which is price. And price has taken crude oil through the wave, the 200 propulsion, and now we've got a downtrend. So as long as the downtrend is there, I've got to believe OPEC and crude are moving on a narrative completely separate from Fed rate cuts. Now, separately, Jay Charles, typically when money is easier to lend and less expensive to borrow, and we have a dovish, accommodative central bank, that tends to bring on risk appetite. And if it does, Jay, I would keep an eye on not only crude, but copper. These are the two canaries in a coal mine when it comes to the commodity view about the optimism of an economy, in this case, the world economy. So not only do I want to see crude move higher in that environment of an accommodative central bank, then boosting optimism about economies and encouraging because of the lower borrowing rate and so forth, companies to scale and etc. I would want to see crude and I'd want to see copper moving higher. And that's the way I would tether crude to the Fed. But right now, again, we know these rate cuts are coming and crude does not give a rip, right? So while I think eventually that'll be the case, it isn't right now. Yeah. All right. Let's see. On a daily chart, what would be a good level and price for a long position in Microsoft? Okay. This would be a great place to wrap up. So let's go index sector stock. So first of all, why would I be interested in Microsoft? I want to look at the NASDAQ, which is clearly heading higher. It's been the leader. And even though it's pulling back some, that's okay. NASDAQ is still a buy the dip. All right. Index. Let's move to sector. Sector is XLK. XLK green? Absolutely. And then lastly, when we get to index sector stock, we have Microsoft. Is Microsoft green? Yes. So buy the dip. Let's go to the daily time frame. Really simple. The question is, if I have index sector stock alignment, that means that there's a higher probability of Microsoft continuing higher because a broader index, a sector that it's weighted within and itself are, generally speaking, going to have a path to the upside. But buy the dip, mean reversion, correction, what have you. Couple ways to look at this. One, I really want price to reach either or and the daily price movement range. And the daily price movement range has been pretty darn consistent for a period of time for us. So for those of you that have the daily price movement ranges in a green environment like we have here, that's a buy. I believe that was, and that. And now we're waiting here, right? So that's going to be the next one. So since basically mid-November, that's not too bad. 2 weeks, roughly. We've had 3 opportunities, worked out pretty darn nicely, and now we're looking at a 4th. Yes? We've also now made, I would look at the wave as a mean reversion. These are pullbacks, right, based on volatility, but the wave is really more of a mean reversion for me. Now, there's no agreed upon mean. It's whatever that trader wants to use. I like the 34 EMA as a mean. Okay. That being said, now we're getting into that zone of, hey, there's a mean reversion, and oh yeah, got two Y's here: daily price movement range and the wave. That's how I do it, and that's the way I want to focus on. Right, that's what I want to focus on, the overall movement higher. All right, gang. As always, thank you so much for being here for Charts and Coffee. I will see you tomorrow, same time, same station. Be good to each other, gang.